Hi guys and welcome back. This is a two-part video, so if you haven't checked out the first, I've linked it in the card above and in the description below. In this segment, we'll get into how to carry out market research, how to fund your idea, how to pitch your idea, how to market and sell your product or service. So let's get into it. Market research, the action or activity of gathering information about a consumer's needs and preferences. After we've come up with a good idea, we want to assess the marketplace to understand if there is an opportunity there or not. The main reasons why startups fail is because of no market need or because they ran out of cash, and you'll certainly run out of cash if there's no market need. We conduct market research to determine market need and price our product or service appropriately. Before we conduct any market research, we need to identify, are there any competitors? How big is the market? Who is the target consumer? What are the barriers to entry? And is there a blue ocean? A blue ocean is referred to as a market for a product where there is no competition or very little competition. Are there some competitors? And if so, the goal is to find them, or as many as you can, and write down what they offer and their individual USPs. Have you thought of something that is not being implemented that could give you a competitive edge? If your idea falls into an established market, we need to think, what can I offer that they aren't? Who stands to value from your idea coming to the marketplace? If I come up with a new job board that uses automation and machine learning to match candidates to roles that they'd be interested in, to find out how big the market is, I'd research how many candidates use job boards to find jobs. My target audience would look a little like this: age, 18 to 65, sex, all, location, United Kingdom, with plans to conquer the world. The example I've used is extremely broad, but the parameters can become quite lengthy. You might need to factor in relationship status, do they have a pet, disposable income, and so forth. Barriers to entry, obstacles that prevent new competitors from easily entering an industry or area of business. A barrier to entry could be intellectual property, high startup costs, customer loyalty, or even government intervention. Each industry comes with its own challenges, and it's incumbent on you, the entrepreneur, to identify and assess these risks. Once we've identified there's in fact a need for our business, we can afford to enter the marketplace, we'll carry out further market research in the form of online surveys, in-person interviews, and focus groups if your budget permits. We'll use surveys and focus groups to understand the marketplace better. We'll use research to initially determine market size, how much the public or businesses are willing to pay, and other essential information that could be required. This type of research is called primary market research. There are various ways to fund your business, circumstantially some good and some bad. I want you to understand the risks involved and how to reduce your liability through funding your venture or leveraging a stake in your business to get the cash that you need. We're going to go through the main avenues to attain funding now. There are a lot of businesses you can start where you're the sole employee. If the idea you'd like to create is inexpensive in the grand scheme of things, for example, a small clothing store or a from-home food service, your best bet is to develop your idea while saving money from your active income to eventually start the venture. If your idea requires more capital, somewhere in the region of 10 to 100,000 pounds, this would be dependent on how wealthy your family and friends are. You could pitch the idea to them. Pitching to family and friends is a brilliant way to strengthen your business plan, as I'd hope they would pick holes in your idea, helping you improve it. Your family and friends want the best for you, so if they could invest in your venture for a stake in your business, that helps you because they've invested and they genuinely believe that you will make a return for them, or they love you dearly. You have a moral obligation to outline the risks involved in investing, because the chances that they are sophisticated investors is very small. I really do not recommend this avenue unless you're in between a rock and a hard place and you have no other means to fund your venture. Please do not take on the burden of personal debt without a guarantee or strong likelihood that you'd be able to repay your debt. Crowdfunding. Crowdfunding is the practice of funding a project or venture by raising money from a large number of people who each contribute a relatively small amount, typically via the internet. With crowdfunding, you could either facilitate a loan for your business or sell equity in your business for working capital. An angel investor is a high net worth individual who provides financial backing for small startups or entrepreneurs. typically in exchange for ownership equity in the company. Often, angel investors are found among an entrepreneur's family and friends. If this isn't the case for you, there are several brilliant sites that I will link down in the description that can connect you to an angel investor. If I personally prefer this route because you could find an investor that has decades in your field and provide amazing insight. This type of investor is usually referred to as smart money because you receive funds and specific knowledge. A VC or venture capitalist is a private equity investor that provides capital to companies exhibiting high growth potential in exchange for an equity stake. This could be funding startup ventures or supporting small companies that wish to expand but do not have the access to equities markets. This is the hardest way to obtain funds. Approximately 1 in every 100 startups achieve VC fundings, and the figure is even lower for emerging startup markets. The ratio is approximately 1 in every 250 or so. The venture capital model works a little like this. You receive investment, the fund manager will want to exit their position typically within 4 to 6 years, and most companies in their portfolio will fail. So they want your company to grow as quickly as possible, sometimes allocating more than 50% of the capital to adverts for the acquisition of new customers. The pressure will be on from day one, not to be profitable, but to grow, so the fund can exit their position at a huge profit, in turn providing profits for their investors.
We interrupt our program to bring you this important message.
If you are enjoying this video and have learned something, please give me a like and subscribe. I really do appreciate your support. If you know somebody that might benefit from this video, help us both out and share. Next up, pitching your idea. We'll be focusing on 2 types of pitches used to garner interest and raise capital for your business: the elevator pitch and the investor pitch. Elevator pitch, a short pitch delivered in the time taken during an elevator ride. An elevator pitch is used to elicit intrigue in one's business idea. The goal is usually to present your idea formally to that potential investor or partner at a later date. Your elevator pitch should be no longer than a minute. Before approaching the potential investor, you should know who they are, what areas they usually invest in. We want the initial interaction to be as organic as possible, but we've rehearsed this elevator pitch 100 times. You want to garner genuine interest before you pitch, so good judgment is advised here. Your elevator pitch should convey the problem and pain point of that consumer, your solution, the size of the market, and how far along your business is, ending with a call to action. Good morning, Mr. Smith. How are you?
I'm well, thank you. How are you?
I'm particularly excited. Actually, my team and I have been working on an exciting tech app for the cab industry.
That sounds interesting. Tell me more.
Well, the current cab model is inefficient. Customers have to call for a cab and wait for it to arrive, oftentimes late or not at all. The process can be simplified using an application. People don't want to wait around, and cab drivers want to earn more without having the risk of a customer running away after they've arrived or waiting for a no-show. Imagine you're late for a board meeting and you need a cab now. You open up our app and you're instantly connected to a network of drivers that are minutes away. The process is cashless and cheaper than a conventional cab, as we don't need to factor in premises and telephone operators. The application will make ordering a cab faster and cheaper, whilst our riders will earn more and be protected from a loss of earnings. The market is worth an estimated $200 billion and is growing at a rate of 7% year on year. I'd like to pitch this idea formally as we're raising capital for marketing and application development. Are you interested in potentially investing? The investor pitch, a formal pitch presenting your business idea to potential investors. How do you structure your pitch? The main elements in a pitch are introduction, team, pain point and opportunity, economics, and roadmap. The introduction should be short and sweet, a greeting followed by the amount of capital you're raising in exchange for what equity for your business. A typical example would go something like this: good afternoon, my name is John Smith. I'm pitching for $500,000 in exchange for 10% of my business, Danger.io. That would value your business at $5 million. You then lead with your strongest foot. If you've built an incredible team, you'd start with this to build credibility. If you're demonstrating strong sales and good growth, start with this. If you've built an incredible product, you get the gist. Put your best foot forward. When presenting your team, the investors are looking for credibility. If your team hasn't worked in your industry previously, you'd need to present why they're a good fit and can help execute the vision. Discuss transferable skills and strengths. You don't want to spend an age qualifying your team. Pick a few highlights that will resonate with the investors. When discussing the pain point and opportunity, you want to tell a compelling story on how you stumbled across this issue without a solution, or the current solutions were inadequate. With a smooth transition, not like that, with a smooth transition into the opportunity for the investors to get involved in. The market is worth an estimated $5 billion and growing at a rate of 6% year on year. Once the problem and opportunity have been conveyed, you're primed to present the solution. If there is a blue ocean, discuss the product or service and how you're going to market the solution. If there are competitors, discuss your solution and how you're adding value in other areas. Numbers and economics of your business. Know your numbers. If you're pre-sales, present your forecast and how you plan on attaining those numbers. If you've generated sales, you'll need to know your annual revenue, your gross profit, your net profit, your customer acquisition cost, and all your expenses. Benchmark your growth across your industry. If you're growing faster, convey this. If your sales are lower than average, state why. Roadmap and plan for the capital. A roadmap is a plan or strategy intended to achieve a particular goal. Discuss future milestones and how you're going to achieve them and how you plan on spending the investment capital. Investors see hundreds of pitches every year. The process can be mundane and predictable. Use graphics in your pitch deck and tell a compelling story. Practice. Polish your pitch. Know inside out, frontwards and backwards so you don't fumble on your words and choke because of lack of preparations. Your ideal pitch should be between 10 and 12 sides. Do not read from your pitch deck. Your pitch deck should be a prompt. To keep the deck interesting, add extra material that isn't part of your spoken pitch. You should be prepared for questions regarding your numbers. Know your numbers inside out, frontwards and backwards. Nothing screams incompetence louder than an entrepreneur without a solid understanding of the economics of their business. Your competition, who are they? If there is any competition, what are they currently doing? How are you going to capitalize on their inefficiencies? How much did they earn over the last few years? Intellectual property, do you have trademarks or patents for your business or products? Are they pending? In what countries have you applied? What are you going to use the cash for? Your plan for the cash needs to communicate development and growth. Investors are interested in returns, and if your plan for their hard-earned cash sounds poor, they're going to decline. Your plan on executing. How are you planning on reaching your forecasted numbers? Are you going to enter a new country, extend a product line, employ more in-house tech or sales, utilize a new sales channel? And why you're qualified to execute on your vision. Previous experience in the industry or business are definite bonuses, but if you don't have either, you need to do some extra homework on the workings of a business and that industry and overcompensate on that research to establish credibility. Marketing, the action or business of promoting and selling a product or services. Our goal when marketing is to sell. We're going to go through the different types of consumers, building a profile, targeting them, and our route to market. When discussing types of consumers, they generally fall into three categories. We have the emotively loyal, the creme de la creme, the dream consumer. Your brand is part of their lifestyle. To lose a customer that's emotively loyal, you're going to have to drop the ball several times before they even think about your competition. They swear by your business and will even market on your behalf. The inertially loyal is loyal out of pure convenience and habit. Convenience is a major player in purchasing decisions. Consumers are more likely to shop at a store that's on their way home than go out of their way to your store. This type of consumer will engage with your business because you've made it easy to. The rationally loyal. This is the hardest customer to sell to. They need convincing every single time before a purchasing decision. The cost of acquiring this type of customer can be 10 times as much as the inertially loyal. They base their purchasing decisions on logic and facts and not emotions. Before marketing your product or service, you want to have an idea of who your target audience is. A basic consumer profile could be age, sex, location, and disposable income. Depending on how niche your audience is or how targeted you want your ads to be, you could add other metrics such as education, occupation, and even relationship status. It's important to understand the demographic of different types of media. Advertising the latest Zimmer frame on Snapchat is going to be useless because my audience generally doesn't use Snapchat. Advertising a new selfie stick in a financial tabloid is equally useless. There are a plethora of marketing strategies, but in this video we're going to be focusing on two: paid ads and word of mouth. Paid ads are exactly what they imply. Some examples are pay-per-click, social media, television, newspapers, magazine, radio, email marketing, direct mail, outdoor, and transit. Word of mouth is free marketing. It usually occurs when a product or service goes beyond the expectations of the consumer, causing them to share their experience. Customer acquisition cost is the cost of winning a customer to purchase a product or service. It's incredibly important to track this metric. Play around with different marketing channels and track the CAC. Your initial campaigns will have a poor CAC, but as you tweak and iterate based on what's working, your rate of return will improve. An example of this is building a lookalike audience on Facebook. We've put in all the work now, it's time to sell. We'll need to identify the cheapest route to market, the route between you and the target demographic that you wish to sell to. The different routes to market are often referred to as sales channels. Let's go through some examples of sales channels. Online sales channels such as your website, Amazon, and eBay. This is a very economical model. Online platforms can eat into your margin, but their reach is much larger, meaning in theory, more sales. There are remote sales channels like brochures and catalogs, and although this channel is a little outdated, some consumers of an older demographic prefer this. The wholesale route is similar to online sales channels. You wholesale your product to a retailer who then make a margin on each sale that they make. Some examples of businesses that use this model are Whole Foods, Boots, and Tesco. The direct sales channel is tried and proven. Direct sales involve handling everything either in person or over the phone. Examples of direct sales channels are insurance providers, investment services, and door-to-door salesmen. You could use one or a variety of sales channels if it makes sense. If you've made it this far, thank you. This video has been pretty high level and I'd love to delve into particular segments in more detail. Let me know in the comments below what you'd like to see. And as always, like, comment, and subscribe. And please turn on those bell notifications and I'll see you on the other side.